Hey. Today is May 5th. It's a Wednesday, and I'm going to be going over the one trade I took today, which was SPY puts. This is actually the fourth time I'm recording this video. The first time I didn't click record. The second time, I don't even know what happened. I think the second time was my laptop shut down, and the third time it didn't finish recording all of the way. But hopefully it works now, and I did take SPY put, so let me go to the ES chart. There really wasn't any higher time frame analysis on this, so I can go straight down to intraday. Okay, so I just want to quickly go over where I entered SPY puts, and then I'll talk about why I entered. So I had entered SPY puts at the break of this bear flag in low a day, targeting 4142 demand, and my stop was when my plan failed. So that may sound a little bit confusing, but essentially I have a fixed target and I tend to scale out on the way down. And my stop is whenever my plan fails or something is wrong in the trade. And I think that's a much better way to have risk to reward, just because if I know my plan failed and if the trade isn't going to work out, why wait for it to hit my stop loss when I know I'm wrong? You know, I can always reevaluate and enter later. So I entered at the break of this bear flag, a little bit below low day. I do play low day and high day breaks, nothing to be ashamed about. It's just part of my strategy. We all trade in different ways. But if you are like me and you do trade high day and low day breaks or key level breaks, make sure you enter a little bit before the break, so you get a fair value for your price. You know, if you enter after the break, then you're buying inflated premium. And if you buy a little bit before the break, you're able to capitalize on this premium spike. So I entered at the break of this bear flag slash low day. Um, and then as soon as we moved lower, I saw heavy buying pressure supported by nice volume as well. Let me just highlight that. So a huge lower wick, nice buying pressure. So as soon as this 5 minute candle closed, I practically got out, and this was a break even trade. Only lost 4 cents, so very, very good risk management on my end. So yep, that was just a little bit about numbers, where I entered and why, or where I entered. And now I'm going to be talking about why I entered, what was the context behind this, and actually how I can avoid this trade in the future, despite it being a relatively good trade. So if you look from the morning, SPY opened up in 4 hour supply and we rejected. To me, this is nice volatility. You know, these candles are nice, 3, 4 points. This was an aggressive drop into demand. So my first confirmation for this trade was, if you're given this amount of data, wait, okay, yeah. So given this amount of data, we aggressively moved lower into demand, and what happened first? Volume spiked. So volume spiked, and if volume spikes up and we're inside of a demand zone, you want to see an almost immediate reaction from buyers, because if we are trading on elevated volume inside of a demand imbalance, then buyers need to prove themselves and carry price forward. But what happened for this 15-minute period when we were on elevated volume? Price really couldn't get above it couldn't really move up aggressively. We had these upper wicks, we had red candles, we were consolidating inside of a demand zone on elevated volume. So what that's telling me is that yes, there's more shares, more it's being traded more in this time period, yet buyers can't take us above. So to me, that's a sign of consolidation for sellers to take us lower. So that was my first confirmation, just price action. I'm seeing how buyers are weak at this demand zone. Second confirmation was elevated volume. You know, this volume from 10 to 10:15 is higher than the initial volume. So that was my second confirmation, elevated volume. My third confirmation was a break of this bear flag. You know, this is a textbook bear flag setup. Uh, we move lower aggressively, consolidate, form a flag pattern, and then break lower. So that was my third confirmation. My fourth and final confirmation going into this trade was Actually Apple, and that may sound a little bit confusing, but because Apple is such a big part of ES and NQ, I've been using it to gauge strength of the overall market. So yes, Apple 130 is a critical level for Apple. Above that, we're bullish. Below that, we're bearish. So when I entered at 1020, what is Apple doing? Uh, in hindsight, it wasn't that way, but we sold off from this 130 key level. We moved above it, but we couldn't hold value. Sold off immediately and consolidated. Set a bear flag below 130. So to me, that told me that the market was relatively weak. A lot of the equities were also choppy and a little bit weak. And I know I don't tend to play SPY; it's not really in my strategy. But the reason I played it today is because a lot of the equities, they didn't really have any momentum. Volume was dying out on them. There really wasn't much follow through, no momentum per se. But what I saw in ES were these huge red 13, 14 point candles to the downside. So this is volatility. This is volume, which I want to be a part of. And I really couldn't find that on any equities. But at last, that was my fourth confirmation, us being below 130 and setting a bear flag for the downside. Obviously, the trade didn't work out. And just talking a little bit more about this trade, this definitely wasn't a bad trade at all. It's had four confirmations and it was backed up by context as well. I know Carmine took this trade as well, but one thing to keep in mind and one thing I can avoid going into the future is I did have a little bit of a bias going into this trade. And I usually don't have biases when I trade. I do a very, very good job of that. But for some reason, I was under the impression that SPY had to drop. Give me a moment. Just need to uh, okay, yeah. I have to end the video quickly because I have to hop on call with Dylan really quickly. But where I went wrong is simply the fact that I wouldn't really call this a sell-off. What's considered a sell-off is a day like yesterday where we break three or four demand zones, just like this. Oh, sorry about that. But if you go to today's action, this definitely isn't a sell-off. You know, we're only approaching the first demand zone. We're not breaking two or three demand zones. If we did sell off into 3 hour demand and put a similar setup, I would have definitely taken that because then I knew the trend would be down and there is momentum towards the downside. But in this case, we really only tested one demand zone, so it's not fair for me to say that the market is weak when we just sold off into demand in the morning. You know, if we broke through two or three demand zones, it would be a completely different story. But that wasn't the case, so that's where I went wrong. I had a bias that the market would head lower, and that's something you don't want to do. You just want to look at price action. You just want to look at the chart, and these type of setups are okay if the market is in a clear downtrend. But this isn't a clear downtrend. This is just us moving lower into the first demand zone and then moving out of it. So yep, that's why I can avoid such trades in the future. I really want to wait for us to determine if we are moving to the upside or the downside. In this case, this isn't considered a sell-off. We only moved 13 points lower into demand. Thursday's action, or not Thursday's, Tuesday's action, which was yesterday, is a sell-off because, you know, we moved 30, 40 points without showing any real period of consolidation. 12, 13 points is not a sell-off. That's just us moving lower into demand. And then we did move up artificially. This is called an artificial move up. When we move up on decreasing volume, that's when, you know, like algorithms are triggered and there really isn't any buying pressure in this market. But I'm going to end the video here. I have to hop on call with Dylan to analyze some stuff, and I will be back to trade tomorrow.